Hey everyone, welcome to this comprehensive explainer on ASC 235. I want to kick things off right away by shattering a bit of an illusion that a lot of people hold about financial reporting. Have you ever looked at a balance sheet or an income statement and thought, okay, I've got it. This is the full, indisputable picture of a company's health. Well, the truth is, those primary statements, they're really just the table of contents. The notes to the financial statements, that is the actual book. That's where all those numbers get their real meaning, their context, and honestly, their validity. Without the notes, you're literally just looking at a summary without knowing the actual story.
Okay, let's dive into this. Here is our roadmap for this explainer. We are going to start with the foundational SSAP, move our way through materiality and estimates, explore subsequent events and related parties, unpack contingencies, handle error corrections, and then finally wrap up by looking at how to avoid some of the most common audit mistakes. It's a packed journey, so let's get right into it.
Section 1, the foundation and SSAP. So, let's establish our absolute baseline from the get-go. The notes to the financial statements are not some optional supplement or just a nice-to-have cosmetic appendix. Missing them or providing incomplete notes is a material deficiency. And trust me, that will easily earn you a qualification or a material weakness finding from your auditors. Under US GAAP, a complete set of financial statements actually includes 6 components. You've got your balance sheet, your income statement, the statement of comprehensive income, the statement of changes in stockholders' equity, and the statement of cash flows. But look at number 6, the notes to the financial statements. They are completely equal in standing to those other 5. They are not subordinate. And the very first note, the one that really acts as the bedrock for the entire disclosure package, is the Summary of Significant Accounting Policies, or SSAP for short. This specific note is critical because it tells the reader exactly how each major line item was measured and recognized. So the crucial point here is that your SSAP absolutely must be accurate and tailored to exactly what your specific entity does. It cannot just be generic copy-pasted text. A perfect example of this is the treatment of goodwill. Indefinite life intangibles and goodwill are never amortized under US GAAP for public entities. They're tested for impairment at least annually. If your team just copies and pastes prior year boilerplate text that incorrectly mentions the amortization of goodwill for a public entity, you are essentially handing the auditor a deficiency on a silver platter. The SSAP has to reflect your actual current practices, not just what a generic textbook company might do. And let's look at a common cause and effect loop where things frequently go off the rails. When an entity adopts a new accounting standard, it is super common for the accounting team to meticulously post the new journal entries, breathe a huge sigh of relief, and then completely forget to update the SSAP. But here's the rule. Every single new standard adoption requires both an accounting entry and a disclosure update simultaneously. If you get all the math right but forget to update the notes, the auditor is still going to hand down a deficiency. The numbers and the narrative must always match, no exceptions. All right, moving right along to Section 2, Materiality and Significant Estimates.
Now that we have our foundation, we need a filter to determine what actually goes into the rest of these notes. And that filter is materiality. But it isn't just a simple math problem. Well, there are quantitative rules of thumb out there, like, 5% of pre-tax income or 1% of net revenue. Those are really just starting points, not hard and fast bright lines. We always have to weigh qualitative factors too. Items like illegal acts, fraud, related party transactions with key management, or covenant violations. Those are always material, regardless of their actual dollar size. And you absolutely cannot hide these qualitatively material items by clumping them together with unrelated mundane notes. A serious debt covenant risk is not the same thing as a standard warranty liability. Burying a material disclosure in a highly aggregated category is just as misleading as omitting it entirely. And the SEC has heavily penalized companies for doing exactly that.
Beyond basic materiality, ASC 275 requires us to explicitly disclose our significant estimates. Now, these are specific areas where management used their judgment and, more importantly, where a change in a key assumption would cause a material change in the financials. Sophisticated users, like your analysts and major investors, they obsess over these disclosures. They don't just want to know your final bottom line number. They want to understand the sensitivity of the entire financial statement. They're trying to figure out just how fragile are these numbers if market conditions change. So what do these look like in practice? Well, the classic areas requiring significant estimate disclosures usually include things like the allowance for credit losses, the useful lives of your long-lived assets, goodwill impairment testing, warranties, litigation contingencies, and variable consideration and revenue. Disclosing these is definitely not a mere compliance exercise. You are required to clearly name the methodology you used and, where it's possible, actually quantify the sensitivity. For example, you might state that a 1% change in the discount rate would change your goodwill impairment conclusion by a specific dollar amount. Using vague, boilerplate language here is entirely unacceptable, and it'll result in a massive audit finding for sure. Let's move to Section 3 and see how this builds into timing and related parties. Up to this point, we've really focused on what happened inside the business during the year. But to tell the full story, we have to look outside that standard boundary. There is an incredibly dangerous myth in accounting that the job is 100% done on December 31st. Under ASC 8055, that is completely false. Teams must keep reviewing events that occur after the balance sheet date right up until the exact date the financial statements are issued or at least available to be issued. This subsequent events review period can last weeks or even months. If your team closes the books on New Year's Eve, pops the champagne, and stops looking out the window, you are missing a mandatory disclosure requirement entirely. But here's the catch. Not all post-year-end events are treated the same way. Let's look at a vivid scenario to make sense of this. Imagine a massive lawsuit that was pending at your end is suddenly settled in January. Because the condition, the lawsuit, existed at the balance sheet date, this is what we call an adjusting subsequent event. You must actually go back into your books and update the accrual numbers in the financials themselves. However, imagine a company warehouse unexpectedly burns down in January. Because that condition arose strictly after the balance sheet date, it is a non-adjusting subsequent event. You do not touch or change the December numbers, but you absolutely must disclose the fire in the notes if the impact is material.
Now, what's really interesting here is the crucial one-year timeframe regarding the going concern rule under ASC 20540. Management is required to evaluate whether there is substantial doubt about the entity's ability to continue as a going concern. But the clock doesn't start ticking at the balance sheet date. Management must look exactly 1 year forward from the issuance date of the financial statements. If substantial doubt exists, maybe due to recurring losses, negative cash flows, or severe covenant violations, you must clearly disclose those conditions and outline whether management's plans actually alleviate that doubt.
Another critical area that sits outside normal day-to-day step operations is related party disclosures under ASC 850. For these, you've got to disclose the nature of the relationship, a clear description of the transaction, the exact dollar amounts, and any outstanding balances. And here is a major danger zone. Informal handshake loans between owners or maybe services provided by family members. Too often, accounting teams only disclose the formal, legally papered agreements. But informal arrangements are equally subject to disclosure. The essential control to catch these hidden arrangements is an annual related party questionnaire that all key management must sign. Oh, and one more thing. Never, ever claim a related party transaction was conducted at arm's length unless you can definitively, legally substantiate it. Section 4. Contingencies and granular disaggregation. Let's shift our narrative forward now and look at uncertain future obligations. The Commitments and Contingencies note, often just called the C&C note by audit teams, is incredibly structured. It generally covers legal proceedings, leases, guarantees, environmental obligations, and warranties. But listen, here is a massive watch-out. People frequently only disclose the items they actually accrued a liability for on the balance sheet. But the C&C note mandates disclosure of both the probable items that you accrued and the items that are merely reasonably possible where absolutely no balance sheet entry exists. Missing those reasonably possible contingencies, it is one of the single most frequently cited audit failures out there. And this brilliantly illustrates the danger of highly aggregated top-line numbers. Under ASC 606, you can't just slap a massive total revenue number on the income statement and walk away. The notes must disaggregate that revenue to show how economic factors actually impact the business. If you sell products globally, using a single vague category like product revenue isn't going to cut it. You need to show geographical slices like North America, Europe, Asia, or slices by product type or contract timing. It's all about giving the user a transparent view into the actual risks driving your revenue. Section 5. Errors, Changes, and IFRS. Okay, we've dealt with the present and we've dealt with the future. Now we have to look at how we fix the past. ASC 250 deals with error corrections and accounting changes. Let's take a beat to unpack this, because it is a highly confused concept. If you voluntarily change your accounting principle, for example, maybe you're changing your depreciation method, you must apply this retrospectively, meaning you have to go back in time and restate all prior periods presented.
However, if you merely change an accounting estimate, like say revising the useful life of an asset because you just got some new information, you only apply that prospectively, meaning just going forward from today. A change in estimate never triggers a restatement. Confusing those two rules is a very fast way to fail an audit. And hey, while we're talking about frameworks, let's briefly contrast US GAAP with IFRS. Generally speaking, US GAAP is very rules-based, where specific standards mandate precise disclosures. IFRS, on the other hand, is principles-based, which relies much more heavily on prepared judgment to present the financials fairly. For instance, IFRS requires very explicit disclosures for capital management objectives and key management personnel compensation by category, like breaking out salaries, stock-based comp, and pensions. These specific IFRS disclosures have no direct general equivalent in US GAAP, which, as you can imagine, creates a ton of significant extra work for entities that have to report under both frameworks.
Section 6. Avoiding common audit mistakes.
As we enter the final stretch here, we have to talk about preparing for the ultimate test, the audit. The absolute best defense against material weaknesses is a chronological, crystal-clear workflow. Step 1. The team member performs the initial identification and preparation, flagging any unusual items immediately. Step 2. The team lead reviews the work and, crucially, escalates any judgment-based conclusions or significant estimates. And finally, Step 3. The manager approves those judgments, reviews the final disclosures, and signs off before issuance. Establishing this exact hierarchy and clear ownership over note preparation radically reduces errors and ensures that borderline classifications are handled properly long before issuance. Let's apply our cause and effect framework one last time by looking at the most common, entirely preventable mistakes. We've talked about the danger of boilerplate SSAP language, missing subsequent events, and inadequate contingencies. But look at the note organization itself. If the note numbers in your actual disclosures do not match the cross-references listed on the face of your primary financial statements, for example, let's say your balance sheet says see Note 6, but the information is actually buried in Note 7, it immediately shows the auditor that your notes were updated independently and carelessly. It completely destroys trust in your entire disclosure package. Always, always do a final cross-reference check. Which brings us to our final overarching thought for this explainer. I want you to ask yourself, do your financial notes just check a compliance box, or do they tell the complete, indisputable story behind your numbers? We've seen today that from the foundational SSAP and the tricky judgment calls of materiality to uncovering subsequent events and mapping out really complex commitments, the notes are where the true financial reality of an entity actually lives. Preparing exceptional notes isn't just about avoiding audit deficiencies, although, let's be real, that's certainly a great benefit. It's about providing true transparency and deep understanding to the users who rely on your work every single day. Thanks so much for joining me on this complete deep dive into ASC 235.